price will take care of the entry in where silver is ultimately going. It's a headlong rush, and you can see it on COMEX, you can see it on the LBMA, you can see in the drawdown in Shanghai. There's a premium on having the real thing in your hands. And
physical metal in Shanghai sitting at $96.71. Premium on average is $11.40, which is roughly about 13.5% over spot.
CME is rapidly losing credibility because of this announcement. Bank of America, their lead precious metals analyst, came out and said that they see, because of the gold-silver ratio being so far askew, that they could see silver hitting $300 by the end of this year.
Would you please give us an idea of when you think silver is finally going to hit 200 per ounce? Many thanks. Why is CME halting trading at the end of the day today?
Who's taking possession of almost 39 million ounces? 5 100-ounce silver bars are going to weigh 40 pounds. You are talking a fleet, 2 blocks, 3 blocks long of semi-trucks. Where's it going? Who's taking possession of it? Isn't that really all you need to know? What else do you need to know? And instead, this is the APs, the authorized participants, which are the big banks, that are taking gold out and silver out of the ETFs very privately without going into the open market and creating what the Commitment of Traders report sees and standing for delivery, which is very, very, very visible. And so this is why I hate GLD and SLV. Not only are they, fully custodied by JP Morgan and BlackRock, but the big authorized participants can create these shares and then pull the metal out quietly. And it's kind of like when we saw the price collapse in silver from 120 down to 65. The prospectus says there's a time lag between when they will book the order and then the shares are created. The shares are only created when the bars go in. So they booked the order at $120. The price collapsed, and at the very bottom, 38 million shares
are created,
found their way into, and they're only created when the metal is deposited. Right, so it's almost, did they really buy it in the 60s? But take the orders at 100 plus, knowing it was going to collapse. These are the things that the ETFs allow. If you own an ETF, you're part of the problem. Get out.
And the funny thing is that you bring up the ETFs because, again, I know that ETF gold holdings rose to an all-time high in January.
A quiet structural loophole may be hiding behind what many investors think is simple ETF exposure. As Andy Schectman points out here, authorized participants, typically major banks, can create ETF shares and quietly remove physical metal without triggering the kind of visible delivery signals tracked in futures data. That matters because retail investors often assume ETFs mirror real market supply, yet mechanisms like creation lags and share issuance timing can distort that perception. When 38 million shares appear after a sharp price drop, it raises a deeper question about who actually benefits from that timing. Next, Andy Schectman discusses the surprising surge in gold ETF holdings despite market turmoil.
So even though there was craziness going on, the gold-backed funds, they continued to add to their assets in February. They added 26 tons of gold last month. Their total holdings was almost 4,200 tons. And even with the pullback in gold, these gold funds hit new all-time highs of $701 billion. So, I understand. This was the 9th consecutive month of positive ETF gold flows globally. And I think the only other 2 times that it happened that way with 9 months was during COVID and during the financial Armageddon. Those were the 2 times.
And the only other thing I want to mention that's probably on a lot of people's radar screen is what we've seen come out of the private equity world, BlackRock and Blackstone, both.
Redemptions.
Yeah, and the redemptions were far greater than they really cared to do. BlackRock gated, meaning the prospectus says, well, we can, if we need to, only allow up to 5% redemptions. They had double that amount. So they paid the 600 and whatever million out of the 1.2 billion in requests. They gated it and said they will pay the rest later. Blackstone did the opposite, and they did it, I think, to save face because, in essence, their managers, the
PMs
in themselves, they came up with $400 million and put it into the fund so that they could do some redemptions.
Sometimes the most revealing signal isn't price; it's where money keeps flowing during chaos. As Andy Schectman points out here, gold ETFs added roughly 26 tons in February, pushing global holdings near 4,200 tons and lifting assets to a record $701 billion despite price volatility. That kind of 9-month inflow streak historically appeared only during systemic stress periods, like the 2020 COVID panic or the 2008 financial crisis. At the same time, redemption pressure hitting major private equity funds suggests liquidity concerns are quietly building beneath the surface of markets investors assume are stable. Next, Andy Schectman unravels why those redemption pressures could signal deeper liquidity stress.
But the point of it is that once you start to see private equity, which was sold to the public as being very liquid, quarterly liquid, the realization is that it's not really that liquid, especially if everyone wants their money at once. And if you see a liquidity problem where people start saying, instead of what's the share price, how do I get my money back? That's a problem. And once you see that jump from private equity, it goes directly to the banks and to the insurance companies and to the reinsurance companies. Then you really have a problem. But don't worry, I'm sure it's contained, just like we've been told before. So I think there are a lot of things that can happen as not only a result of this war, but a result of a wayward sense of trust around the globe.
We talk about it every week, trust,
and
the breach of trust that we're seeing all over the place. I think that's common theme here.
And so indirectly, these kind of things can spill into places like private equity, BlackRock and Blackstone. And if that gets into trouble, the spillover creates things that no one even saw coming.
I mean, look, if you're talking about Blackstone and BlackRock putting, collars and gating on redemptions, I do think it's a reason to raise your eyebrows. Of
course.
Liquidity always looks abundant until everyone tries to leave at the same time. As Andy Schectman points out here, private equity has long been marketed as quarterly liquid, but redemption gates from massive firms like BlackRock and Blackstone challenge that narrative. When investors stop asking about performance and start asking how quickly they can get cash back, the shift often signals stress spreading through the financial plumbing, from funds to banks to insurers. History shows liquidity crises rarely start in the obvious places investors watch. Next, Andy Schectman talks about how those liquidity cracks can ripple through the entire financial system.
I mean, you're talking about monsters, huge Goliaths in the industry, and they're saying, well, hold on, we're not going to give everybody their money.
And there's some reality that if they dump everything, you blow up the fund. But that's the point. It's that, if enough people say, give me my money, then you have a problem. And so liquidity is an issue in an environment, little by little, then all at once. As liquidity dries up, first there's a little bit and a little less and a little less, and bang, it's all gone. And then people need their money, and then the whole system starts to
break,
like we saw in 2019. Let's take some questions.
All right, here we go. Starting off with Henry Padilla. If you would address the issue of GSR getting to an attractive place, and also the issue of gifting precious metals to families so as to avoid leaving them a tax situation. Certainly I think that the GSR, an attractive place, still stands to reason. Andy and I still believe, at least I'm not going to speak for him, but I know what his numbers are. As we approach getting under 50 is a good time to start to peel back a layer of the onion.
The financial system rarely collapses overnight. It usually drains liquidity slowly until one moment exposes the weakness. As Andy Schectman points out here, when even the largest investment giants begin limiting withdrawals, it reveals how fragile supposedly liquid markets can become under pressure. Investors often forget that funds holding illiquid assets can't instantly return cash without selling into falling markets, which risks triggering deeper instability, like the liquidity shock seen in late 2019 repo markets. That's when small cracks suddenly become systemic stress. Next, Andy Schectman discusses the gold-silver ratio and why it may signal a strategic shift for precious metal investors.
From your silver and start putting into some gold as it goes down, maybe another 5 or 7, GSR points from there. You peel back another layer and you start doing another little bit by little bit. That way you're always taking a little bit from a higher, or a lower GSR, ratio. I think that's a smart way of doing it.
Bank of America, their lead analyst, their lead precious metals analyst, just came out and said that they see, because of the gold silver ratio being so far askew, that they could see silver hitting $300 by the end of this year. And 309, I think, was the number. The guy's their lead precious metals guy. And he says that in the light that he sees gold going much higher. And historically, silver will have to come along for it, and will probably slingshot the way that it typically does. He's basically saying that he sees silver going much higher in the face of higher gold, which would present an opportunity probably to capture that gold silver ratio. But to your point, Kevin, I wouldn't start really thinking about it until it's in its 50s, and I would only do some of it. I think that's wise.
Sometimes the most revealing signal isn't price itself, but the ratio between two assets drifting far from historical norms. As Andy Schectman points out here, the gold-silver ratio has stretched to levels that historically preceded major catch-up rallies in silver. When Bank of America analysts float projections near $300 silver, it reflects the math of that imbalance rather than pure speculation. Silver historically accelerates faster once gold leads the move. For investors, the strategy he outlines is essentially rebalancing across cycles instead of chasing headlines or short-term spikes. Next, Andy Schectman discusses why predicting silver's timeline is far harder than forecasting its direction.
Andy, would you please give us an idea of when you think silver is finally going to hit 200 per ounce? Many thanks. I can answer this one for you.
Great, because I can't.
Okay, it's going to hit 200 after it hits 150. There you go.
Like you're like Karnak.
Hey, listen, I just know. When you know.
Remember Karnak?
Yeah, of course. Like this.
Yes.
When you know, you know. Why is CME halting trading at the end of the day today? I didn't know that the CME did halt trading. Did you know?
I'm sure it's just a glitch.
Yeah, I'm sure it is. I mean,
we've
if
seen
it's metals,
four of
then
them
it's a glitch, right? I mean, it's unbelievable.
Two of them on the upside, two of them on the downside, but it's just a glitch.
We'll look into it. I wasn't aware of it. We were swamped, but I know it's definitely trading right now because I see that the futures right now are at 87.53, and for the day it's showing up $3 and just about 1 cent, which is about a 3.5. Gold is sitting right now at 51.42, up around 38.10 from the close. So they're both in platinum, sitting at 21.79. So
CME is rapidly losing credibility because of this nonsense.
Sweeney 55. How long can the price difference continue between East and West?
Until there's no metal left to sell.
When markets start glitching, investors should pay attention to what the system quietly shrugs off. As Andy Schectman points out here, even small disruptions in trading platforms or unexplained halts can chip away at confidence in exchanges that are supposed to anchor global price discovery. Silver futures hovering around $87 while gold trades above $5,100 shows how volatile the environment has become. Yet the deeper concern is credibility. Once participants question the integrity of the market structure itself, liquidity can vanish quickly. History shows trust disappears long before prices explode. Next, Andy Schectman talks about the growing price gap between Eastern and Western silver markets.
Yeah, and I think we're literally one big delivery away from that happening.
Yeah, and a lot of people are confused because I read an article from my buddy Alistair McLeod, and I even think he was confused that saying it's not possible to arbitrage because the VAT eats into the premium, but the VAT is the responsibility almost always of the recipient, and not even until it leaves the exchange. So right now you have a $13 and a spread and a 13% VAT. That's how bad they want it. And if you're choking on dollars and you're looking for ways to find value for dollars that are losing value, well, you buy it when it's uneconomical. So what? The price will take care of the entry in where silver is ultimately going. It's a headlong rush, and you can see it on COMEX, you can see it on the LBMA, you can see in the drawdown in Shanghai. There's a premium on having the real thing in your hands, and an easy way to say it is that is that the metal is worth more than the dollars that are used to buy it. And if they're choking on a dollar surplus, what better way to get rid of it than things that are eternal?
Price gaps between global markets usually close quickly unless something deeper is happening with supply. As Andy Schectman points out here, a $12 to $13 spread in silver, despite taxes and transport costs, suggests buyers in parts of the world are willing to pay significant premiums just to secure physical metal. That kind of behavior typically appears when investors distrust the purchasing power of the currency they hold, not merely when they expect a routine price rally. For long-term investors, this signals a shift from speculative trading toward wealth preservation behavior. Next, Andy Schectman discusses the Shanghai premium and what it reveals about real physical demand.
And as we speak, we have the price of physical metal in Shanghai sitting at $96.71. Premium on average is $11.40, which is roughly about 13.5% over spot. So look, it can go on, but eventually, like Andy said, eventually it's going, price discovery will happen through the physical channel.
Yep.
Eventually that's what's going to happen. So let's go through. All right. Hey, this is from Wayne Robertson, 7011. Hey guys, question. If the whole metals market is controlled and is, what does your guess of what's going to happen in a honest market?
Rapid price discovery. What does that look like? When, futures control the market, what would price have been had we not seen, a glitch on Thanksgiving Day? What would it have been had we not seen a glitch last week and then falls by $4 immediately? What would price have ultimately done if the circuit breakers are working on the way down?
A 30.5% premium in a major global metals hub is not a small anomaly. It's a signal about where real demand sits. As Andy Schectman points out here, silver trading near $96 in Shanghai, while Western spot prices sit much lower, suggests futures markets may not fully reflect physical supply pressures. Historically, when physical premiums persist for long periods, price discovery eventually shifts away from paper trading toward real inventory constraints. For investors watching macro trends, this is less about short-term volatility and more about where the global pricing power might migrate next. Next, Andy Schectman unravels what an honest price discovery process could mean for silver markets.
That's what my biggest question is.
And so when you have a market that's never truly been allowed to find price discovery, that is finding it the hard way, the old-fashioned way, where it's really about physical supply. In an environment where physical supply through these channels never mattered, it does now. And so I think much, much higher, not only because we don't know what it's really worth, but also because I think you have ultimately a problem with the value of the dollar. I think in dollar terms, higher than most people would bank on. I'm not telling you to buy it for that reason. Conversely, I kind of am, not to become wealthy, but because holding your wealth in dollars has proven to be a losing game. And we talk about this house example all the time, where price of gold in 2005 was $450 and the average house was 240,000. That's just over 500 ounces. Your house doubled. It's 500,000 across the board right now, average in this country. So good investment in dollars, but was it? Because it's lost 500% in gold.
The quiet shift from paper pricing to physical supply is often where real market revaluations begin. As Andy Schectman points out here, when metals start finding price through actual inventory constraints rather than futures trading, valuations can move far beyond what traditional models predict. The comparison between gold and housing since 2005 illustrates a deeper point. Assets that appear to rise in dollar terms may simply be reflecting the declining purchasing power of the currency itself. For long-term investors, the real question isn't nominal returns, but what those returns actually buy. Next, Andy Schectman discusses how that purchasing power shift completely reframes wealth preservation.
Where those same 510 ounces right now are worth $2.6 million. It buys you 5 fully furnished houses instead of the one house that you doubled your money on. So anyways, saving in dollars is a sucker's game, period. So I think
saving dollars destined to go broke.
Yeah, it'll go higher than you can imagine in the light of both.
All right. Let's see. That's another one.
That's in 20 years, by the way. It's not
that far off. Sure not. Question. I saw price stuck on Kitco and I Google search it and appeared it halted today at before 3 p.m. I was on conference calls today from 2:30 on.
I wonder if it has anything to do coinciding with, what the sharp drop in oil.
In oil, right? Would it surprise you?
No, that's what they did last time.
Right, exactly. And by the way, what people have to realize is where there's smoke, there's fire. And when there's blood in the waters, the sharks come out. And what I mean by that is, so if we take on January 29th, for example, and we saw that when the market opened and the circuit breakers should have halted trading.
When an asset suddenly buys 5 times more real goods, it forces investors to rethink what growth really means. As Andy Schectman points out here, the gold to housing comparison reveals how measuring wealth only in dollars can hide massive shifts in purchasing power over decades. A house doubling in nominal price since 2005 may feel like success, yet priced in gold, the same asset actually lost significant value. A reminder that currency inflation quietly distorts financial reality. For long-term savers, the risk isn't just volatility but slow erosion of real wealth. Next, Andy Schectman talks about unusual trading disruptions and what they might signal beneath the market surface.
The algorithmic traders out there, and there are so many of them with such insane buying power and capability, they just lay in. They just lay in and lay in and lay in. And that's the reason why they were able to so easily push it down 30+%. And of course, where was any, by the way, the chances of silver or gold for that matter going up more than 10% on any given day is virtually nil.
Right.
It wouldn't be allowed to happen. The powers that be.
You mean not silver and gold, you're talking any other asset.
Well, I'm saying without any halt, the fact that silver and gold, if equities go up and the futures go up, I mean, look, it's hard for the Dow to go up 10, 15% on a daily basis because it's basically all the other companies that have to do the same thing. But silver going down 35% on that day and the circuit breakers not triggering, that is not nearly as much of a shock as I don't believe that silver or gold can ever go up 30+% because the circuit breakers.
The uncomfortable question investors rarely ask is whether market rules apply equally in both directions. As Andy Schectman points out here, algorithmic trading power can accelerate downside moves dramatically, yet similar upside volatility would likely trigger immediate circuit breakers and regulatory scrutiny. A 30% plunge in a commodity like silver can happen rapidly when large automated trading systems stack orders, but a symmetrical 30% rally would almost certainly halt trading within minutes. That imbalance doesn't automatically prove manipulation, but it does highlight how market structure can shape outcomes. Next, Andy Schectman discusses why downside pressure often benefits powerful market participants.
Yeah,
it would be working.
The server would overheat.
Right, and there would be nothing to cool it down and they have to shut it down. Right. But my point is, it's just on the downside where they want it to be is when it's to their benefit.
And at what expense is it to their benefit? Because you're beginning to see the mass exodus. Like we talked about February, there was roughly 24 million ounces delivered in the February contract, a non-deliverable month or a non-delivery month. They can still take delivery, not a primary delivery month. 38 million ounces left COMEX. So 160% of what was delivered or could be explained by delivery left. And who's taking possession of almost 39 million ounces? If and I keep saying it, 5 100-ounce silver bars are going to weigh 40 pounds. Who's taking possession? That's 500 ounces of 39 million ounces. Right. You are talking a fleet, 2 blocks, 3 blocks long of semi-trucks. Where's it going? who's taking possession of it. Isn't that really all you need to know?
That's it.
What else do you need to know?
Sometimes the most important market signal isn't price. It's where the physical inventory is quietly moving. As Andy Schectman points out here, roughly 38 million ounces leaving COMEX during a non-delivery month raises a fundamental question about who is accumulating that metal and why. When withdrawals exceed reported deliveries by more than 160%, it suggests strategic positioning by entities with long-term demand rather than short-term traders. For investors tracking supply dynamics, movements like this can hint at tightening physical markets well before prices reflect the shift. Next, Andy Schectman unravels who might actually be taking possession of that silver.
These people are not messing around at this level. Is it the Exchange Stabilization Fund? Is it the government? Maybe. It is critical. Exchange Stabilization Fund says if it's for national security, which critical minerals by definition are, you don't need to tell anyone or get congressional approval. So maybe they knock it down on paper, stand for delivery, and bye-bye, out it goes at a very, very cheap price. Would anyone put that by this administration to do that? And I'm not saying anything bad about it. Maybe it's cunning, right? They've played this game long enough to suppress the price so people wouldn't, sell dollars. Well, what if they're doing it themselves right now, knowing that they need to accumulate this stuff before the music stops? Could it be? I don't know. I'm just saying. So expect volatility. But in the end, the deliveries by these people who are more sophisticated and more informed than any of us combined is all you need to know. Chill a little bit.
Yeah.
The price will take care of itself.
100%. PJ Bowler, 3129. If the military will always require silver, which they will they ever let silver reach its true price in the market?
The most uncomfortable market theory is the one where governments quietly become the biggest buyers. As Andy Schectman points out here, mechanisms like the Exchange Stabilization Fund allow strategic purchases of critical materials without public disclosure when national security is invoked. If silver truly sits on the list of essential military inputs, from electronics to missile systems, then price suppression, followed by silent accumulation, becomes a strategic possibility, not just a conspiracy theory. Investors should remember that commodities tied to defense supply chains rarely trade like normal markets. Next, Andy Schectman discusses whether governments would ever allow silver to reach its real market price.
Well, that's what we're talking about. I think that at the end of the day, true price discovery will come from the physicality of the market.
Well, first of all, silver is inelastic, and the propaganda I'm spewing about silver needs in the military industrial complex, go to silverwars.org, check it out. I'll find the article that was just printed, and it was fantastic. Someone sent it to me as well. I'll send it. I'll post it. But it's inelastic. There's only a little bit of silver in comparison to the overall cost. And price floors that the administration wants to put in place is to incentivize domestic mining. So can you really cap a price when it's globally sought after and universally depleting? I don't think you can. In fact, maybe they want it to go higher. Maybe that's part of the game plan, is to get everyone out there mining it for the U.S. government and let it just go much higher. I don't think they care about the cost.
Sometimes the real signal in commodity markets is scarcity, not speculation. As Andy Schectman points out here, silver behaves as an inelastic resource, meaning supply cannot quickly expand even if prices rise sharply. Global mine production has been roughly flat for years, while industrial demand from electronics, solar panels, and defense systems continues climbing, creating structural pressure that futures markets alone cannot resolve. Governments pushing domestic mining incentives may actually welcome higher prices if it accelerates new supply development. For investors, that creates a paradox where higher prices become policy support rather than resistance.